All right, let's jump right into this explainer by facing a hard truth that frustrates, well, pretty much every retail trader out there on a daily basis. If you've ever felt like the market is literally hunting your trades, trust me, you are not alone. And the crazy part, it's really not in your head. Today, we're tearing down the hidden mechanics of institutional trading to figure out exactly how the true heavyweights actually operate. So many of us enter the market thinking, hey, everyone's got an equal shot here. You crack open your laptop, load up your favorite charts, and kind of just assume it's a level playing field. But man, the reality? You are playing against the big boys, and they are operating with a completely different set of rules. As our sources point out, nearly 90% of retail traders lose money, and it's mainly because they just don't realize they're stepping into a highly sophisticated, completely unequal arena. So here's what we're going to unpack today. First, the unfair market game. Second, how capital completely changes trading processes. Third, we'll dive into risk management and VAR. Fourth, we're tackling liquidity traps and iceberg orders. And finally, the best part, spotting the smart money. Let's get into it. Starting off with that unfair market game, the illusion versus the reality. It's absolutely crucial to know exactly who you're up against out there. See, retail traders often get caught up trading on hype, chasing the latest social media signals, or, just blaming market makers when things inevitably go sideways. But institutions, they're running strictly systemic, logic-driven models. They definitely aren't doom scrolling for stock tips. They're using co-located servers that give them latency arbitrage. Basically, they're physically closer to the exchange, which means they get the data microseconds faster than us. By the time your screen flashes a buy signal, they've already executed their entire trade.
Moving into our second point, capital and trading processes. It's basically David versus Goliath here. And what's truly fascinating is how the sheer massive volume of money completely rewires how decisions are actually made.
Think about it. Retail traders are almost always heavily undercapitalized. We're trading our hard-earned savings, which means we end up acting as the judge, jury, and executioner for every single trade. And naturally, that lets emotion take the wheel. Institutions manage billions, and because of that, they rely on strict investment committees. This setup completely strips emotion out of the execution. The process stays exactly the same, even if the guy running the fund gets swapped out. There's a quote from the source material that really hits the nail on the head here. They want you to go and put the money at risk and trade large. They understand that you may lose the $500,000, but then they'll give you another $500,000. That's wild, right? For a retail trader, a massive 50% drawdown could literally end your career. But institutional traders are actually encouraged to take aggressive risks. They have the financial backing to absorb massive losses, and they just get continuously recharged with new capital to keep hunting for those huge returns. It's a completely different risk profile. All right, part 3, risk management and VAR. How on earth do these massive funds protect their billions when they aren't using the basic tools that we rely on? Instead of dropping those easily visible hard stops right on a chart like we do, the big players rely on incredibly sophisticated math. The big one to know is called value at risk, or VAR. Basically, it's a statistical model that estimates the probability of how much a massive, diversified portfolio might lose over a set period. It completely takes human emotion out of the equation and replaces it with cold, hard statistics. And watch how this actually translates into their execution. When one of these risk thresholds is breached, they do not panic and market sell everything. No way. Instead, they systematically reduce their exposure. They carefully unload their shares into areas of high market liquidity. Think right at the opening bell when retail volume is going crazy. They do this so they don't accidentally crash the price of the very asset they're trying to dump. Which brings us nicely into our fourth point, liquidity traps and icebergs. If you constantly feel like you're getting stopped out, this explains exactly why. Because these institutions need absolute massive amounts of liquidity to exit their billions in capital, they use what are called iceberg orders. Just like it sounds, they break down a massive market-moving order into tiny, virtually invisible pieces. They slowly sell their enormous positions to eager retail buyers without making any market noise. And this quiet, sneaky offloading, that's exactly what creates those breakout traps we see all the time. It's the classic false breakout. Every trading textbook teaches retail traders to buy when a stock hits a new high. Well, the institutions know you read that textbook. They actually use all those retail buy stops, sitting right at the breakout level, to fill their own massive sell orders. You buy the breakout, completely expecting it to soar, and you effectively serve as the exact liquidity they needed to safely exit their position at a premium price. And then, bam, the price instantly reverses. But listen, It is absolutely vital to remember this. Institutions are not hunting your specific 10-share stop loss. Seriously, they aren't looking at you. They are hunting massive groups of stops. When you're moving billions of dollars, you are literally forced to hunt for large clusters of retail liquidity. They need that volume to execute their trades. Otherwise, they just move the price aggressively against themselves.
So let's get to part 5, spotting the smart money by reading the footprints. This is hands down the most empowering part of this explainer. You can actually learn to spot Goliath's footprints right on your own charts.
And according to the experts in our sources, you don't need any magical secret indicators to do it. To spot where the smart money is actually accumulating, you just need to evaluate market levels using 3 observable criteria: time at the level, strength of departure, and the base-to-distance ratio.
Let's break down that first one, time. When institutional traders are acquiring huge positions, the price absolutely should not struggle or consolidate for very long at that level. They are going to quickly scoop up whatever volume is there. A great rule of thumb to use is the 6-candle rule. If the price spends fewer than 6 candles at a level before just taking off, it's a massive sign that institutions are aggressively defending it.
I absolutely love the analogy the sources use for this. Think about it like finding a crazy discount at the supermarket. If you walk in and see your favorite $25 beer on sale for $5, you aren't going to stand there scratching your chin, right? You're going to scoop up as much as you can immediately. Well, institutions act the exact same way when an asset hits their target value. The result? Very, very little time spent at that price level. Okay, criteria number 2, strength of departure. A true institutional footprint isn't just going to give you a little bounce. It's going to feature an explosive, extended range move away from that level in a single direction. You want to see big, powerful candles. A slow, sluggish crawl away from a support level, that just shows a lack of real conviction. Explosive speed, on the other hand, proves heavy capital just slammed into the market.
And finally, criteria 3, the base-to-distance ratio. For the setup to really be valid, that explosive departure we just talked about needs to travel at least 3 times the distance of the original base. So let's say the base of the consolidation is 25 pips wide. That means the ensuing rally has to cover at least 75 pips. If you hit that 1-to-3 ratio, boom, you've highly likely found a valid institutional level.
And this whole thing leads us to your ultimate advantage, the retail edge. See, while institutions are literally trapped by their own massive size, forced to use icebergs, constantly hunt for liquidity, and wait for the opening bell just to move their money, your small size is actually your biggest superpower. Your agility as a retail trader lets you spot their footprints, ride their coattails, and then exit the market in an absolute instant.
So now that you actually understand the hidden mechanics of how this game is played, the choice is totally yours. Are you going to keep acting as the liquidity for these massive funds? Or are you going to use your agility, read the footprints, and start trading alongside the smart money? It's time to start looking for those explosive departures and take control of your trades.